Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at a stock that is a third of the price that it was at its high. This stock is Medifast, ticker MED. It had hit a peak of about $305 back in mid-2021, and today it's trading for right around $90. So what's going on here? Why is the stock trading down, and is it potentially a buy? Because it's down in the buy range, but is it a quality company, and does it have growth potential? That's what we're here to take a look at. So we see that the buy range is right around the $113 mark. Fair value would be mid 130s, and then overvalued would be close to $150. So there's not a whole lot to look at with this stock. I mean, it had a nice run up and really picked it up back in 2018 and has kind of been trading on a very exaggerated zigzag since then. Right now we're at a zone where it saw quite a bit of consolidation back in 2019. It sat there for a little bit. So that is something that shows potential for the stock to rebound out of this area. But we can now get into the numbers and see what those are telling us. And here we have the financials for the company. So revenue, we do see a bit of a dip. Revenue this year is expected to be lower than it was last year. They were on a very solid trend, growing about 30% year over year. This dip, these next 2 years are analyst projections. And then hopefully they can get back on track from what they saw last year in 2025, if they can come through with some growth. But we can look at the earnings yield here, and it's had strong earnings yield across the board. It has decent margins, right around the 10% range. The expenses as a portion of revenue is kind of up and down from 87 to the 85s to 88. And their gross profit sits around the low to mid 70s. It has been shrinking since 2019. It went 75, 74, 73, 71. So that is a bit of a cause for concern that the gross profit is shrinking. The share count, they're buying back shares. That is something that we'd like to see. And their free cash flow has been strong yield, averaging over 10%, and was very strong this last year, with almost $178 million, making it all the way through its free cash. They're good at growing their assets. They're even better at growing their liabilities, though, which is not great. Their assets do far outpace their liabilities. One issue here is their debt to equity ratio is over 1. We want this to be as low as possible, so that is a red flag, is they are heavy in debt and they're growing their debt. They have quite a bit of cash per share, nothing too crazy. And they do have a positive tangible book value, which is something that we like to see. As for their dividend, they're a strong dividend company. They were really good in growth, growing at over 20% year over year. They've really slowed it down. With their last raise, it was only 1 cent per quarter. So if we assume that it's kind of becoming more of a slow growth dividend stock to just get that king or aristocrat distinction, we'd be looking at rates such as these. And it currently yields 7%. Based on the free cash, at least what they had shown last year. That's probably a pretty safe dividend. PE, it trades right around the 14 PE mark. Currently, it's down at 12. So the earnings and the dividend show it's a little undervalued from the market's standards. And we see that the projections for this year give us fair value around 130. At the end of last year, that was 175. So there is a pretty big dip in there because we lose out on earnings with the lower revenue, lower expected earnings. Cash flow, there's a big drop. All that I'm using to predict this cash flow is the average cash flow yield. So right around 10% of the top line. The balance sheet grows a little bit and the dividend grows a little bit. But it takes a huge hit on cash flow. And it was just an extreme year for cash flow this last year. So that's nothing to be too worried about. So it'd be undervalued under 110, overvalued above 144. And then projecting out going forward, we'd be looking at 115 next year, 136 the following year. And the overvalued moves itself all the way up to 180. This stock is interesting because if we look at the share price, it was 82 in 2019, then 176, 187, 113, and then 93. So it kind of hit its peak in 2021 and has been going down since then, even though 2022 was in line with the top line and the earnings were down a little bit. So it is showing just a continual decline in their earnings since 2021. But analysts are expecting that to turn around this next year. The free cash flow wasn't even the best in 2021. It improved in 2022. The liabilities did see a massive jump, but the assets did as well. Tangible book value saw a decent jump, 30%. So there were a lot of moves in 2021, and there's been a bit of a decline since then. In 2022, assets were down, liabilities were down too, but not quite as much as the assets. Tangible book value lost almost a quarter. Super strong ROE, 93%. My biggest concern here would be this debt to equity ratio. And that's my one concern. I don't know if I want to rate this a buy. I'm leaning towards the buy side because it definitely seems to have some potential, especially if this next year is a turnaround year for them, as it's projected. But they're at least strong in their cash flows and will likely be able to sustain that dividend. I don't think the growth that we had seen is going to keep up. I think they're going to be one of those companies that pay out just an extra 1-2 cents per quarter in dividends every year. But with the starting yield, this looks like a decent dividend stock. So I'm going to have to rate it a hold, leaning towards the buy side. And we'll have to keep an eye on this one because I'm sure once it starts turning back around, once we start seeing stuff going back to the 2021 levels, we're going to see the stock go up pretty quick. I mean, it seems like this is a company that the earnings really sway the stock price, and we'll have to stay on top of those to see what's going on. So I want to thank you guys for watching. Please like if you enjoyed the video, you learned anything. Subscribe if you want to see more like it. Comment, let me know what stocks you want to see, and I will catch you next time.